Hello, fellow traders. Today we'll explore how economic indicators can impact the stock market. Economic indicators are statistics that provide information about the health of the economy. Investors use these indicators to make informed decisions about how their investments are in the stock market. Today we'll cover economic indicators in the stock market by Pajama Trader. Gross Domestic Product Growth, GDP. Gross domestic product, or GDP, is a key indicator of the overall health of an economy. It represents the total market value of all final goods and services produced in the country in a given year. Strong and consistent GDP growth is a positive sign for the stock market. It indicates a growing economy with expanding businesses. This can lend to increased corporate profits and higher stock prices. Conversely, weak or negative GDP growth can signal a recession, which is a period of economic decline. During recessions, businesses often experience lower profits or even losses, which can lead to lower stock prices. GDP is the total market value of all final goods and services produced in a country in a given year. Strong GDP growth indicates a healthy economy, which can lead to increased corporate profits and higher stock prices. Weak GDP growth can signal a recession, which can lead to decreased corporate profits and lower stock prices. Unemployment rate. The unemployment rate is another important economic indicator that can impact the stock market. It represents the percentage of the labor force that's unemployed and actively seeking work. A lower unemployment rate is generally positive for the stock market. It indicates a strong economy with businesses hiring and wages rising. This can lead to increased consumer spending, which can boost corporate profits and stock prices. On the other hand, a high unemployment rate suggests a weak economy and businesses laying off workers and wages stagnating. This can lead to decreased consumer spending, which can put downturn pressure on corporate profits and stock prices. The unemployment rate is a percentage of the labor force that is unemployed and actively seeking work. A low unemployment rate indicates a strong economy with a high demand for labor. This can lead to increased wages and consumer spending, which can benefit the stock market. A high unemployment rate indicates a weak economy with low demand for labor. This can lead to decreased wages and consumer spending, which can hurt the stock market. Inflation rate. Inflation is the rate at which the prices of goods and services in an economy increase over time. A moderate rate of inflation, typically around 2 to 3%, can be a positive sign for the stock market. It can encourage businesses to invest in order to expand their production and capacity to meet growing demand. It can also encourage customers to spend before prices rise further. However, high inflation can be detrimental to the stock market. It can erode corporate profits by increasing business costs. It can also reduce the purchasing power of investor earnings, savings, making them less willing to invest in stocks. The inflation rate is the annual increase of prices of goods and services. A moderate inflation rate could be a sign of a healthy economy. It can encourage businesses to invest and customers to spend. High inflation can erode corporate profits and reduce the purchasing power of investor savings. This can lead to lower stock prices. Interest rates. Interest rates plays a crucial role in the economy and can significantly impact the stock market. When the Federal Reserve lowers interest rates, it becomes cheaper for businesses to borrow money. This can lead to increased investment, expansion, and subsequently higher corporate profits. Additionally, lower interest rates can encourage consumer spending. All of these factors positively impact stock prices. Conversely, when the Federal Reserve raises interest rates, it becomes more expensive for businesses to borrow money. This can lead to decreased investment, slower growth, or even contraction, and lower corporate profits. High interest rates can also make bonds more attractive as investment relative to stocks, leading to money flowing out of the stock market. Interest rates are the cost of borrowing money. Low interest rates makes it cheaper for businesses to borrow money to fund expansion. This can lead to higher corporate profits and stock prices. High interest rates makes it more expensive for businesses to borrow money, which can reduce corporate profits and put downward pressure on stock prices. Consumer confidence. Consumer confidence measures the overall optimism consumers feel about the state of the economy and their financial prospects. High consumer confidence suggests that people are more likely to make large purchases such as homes, cars, and appliances. This increased spending can drive business revenues and profits up, leading to higher stock prices. On the other hand, when consumer confidence is low, people are more likely to save their money and reduce spending. This can negatively impact businesses' profitability, leading to lower stock prices. Leading versus lagging indicators. Understanding the difference between leading and lagging indicators is important when analyzing economic data and its potential to impact the stock market. Leading indicators often offer insights into where the economy might be heading in the future. They can help investors anticipate changes in the overall economic environment. Conversely, lagging indicators confirm existing trends, often reflecting what has already happened in the economy. Leading indicators. Economic metrics that change before overall economy begins trending in a particular direction. Examples include stock market performance, consumer confidence, and manufacturing orders. Lagging indicators. Economic metrics that confirm existing economic trends. Examples include employment rate, inflation rate, CPI, and GDP growth. Impact of economic indicators on specific industries. It's important to recognize that economic indicators don't impact all sectors in the stock market the same way. Some industries are more sensitive to economic conditions than others. For example, when interest rates rise, companies in the technology and real estate industries often see their stock prices go under pressure. This is because higher interest rates can increase borrowing costs. Rising inflation can also hurt companies that produce consumer goods, as it puts upward pressure on the input cost and erodes customers' purchasing power. In a strong economy, cyclical sectors like industrials and materials tend to outperform as overall demand for their goods and services increase. Economic indicators impact different industries differently. For example, rising interest rates can negatively affect interest-sensitive sectors like technology and real estate. Inflation can put pressure on this consumer goods sector. A strong economy usually benefits cyclical sectors like industrials and materials. Monitoring economic indicators. Investors and analysts closely monitor economic indicators to make informed decisions in the stock market. It's helpful to track key indicators regularly to stay on top of changing economic conditions. Several resources provide reliable, up-to-date economic indicators. The U.S. Bureau of Labor Statistics, BLS, is a primary source for data on topics such as unemployment and inflation. The U.S. Bureau of Economic Analysis, BEA, is the authoritative source for data on GDP growth and other key economic metrics. The Federal Reserve provides crucial insights on interest rate policy and the overall state of the economy. Additionally, financial news websites offer real-time updates, analysis, and expert commentary on economic indicators and their potential to impact the markets. Important resources: the U.S. Bureau of Labor Statistics, the U.S. Bureau of Economic Analysis, the Federal Reserve, financial news websites, example Bloomberg, Wall Street Journal, and MarketWatch, and others. Just a quick pit stop. I've identified several intriguing companies with the potential for significant developments next week, and I'm looking forward to sharing their charts and their analysis with you. They are Ollie Bargain, ticker symbol OLLI, Block Inc., ticker symbol SQ, Roku Inc., ticker symbol ROKU, and SoFi Technologies Inc., ticker symbol SOFI. Charting of Ollie's Bargain, ticker symbol OLLI. I feel consumer spending is slowing down, and because of this, discount stores are going to be the compass here. This has an average volume of 1.5 million. The high volume of 2.9 million happened in the 61 area, but sold off at $78 and with the same amount of volume. This can get to the mid 80s with average volume, but could fall back to 60 if the volume lessens. Charting of Block Inc., ticker symbol SQ. Another one in the consumer space, but paying for is growing. In saying that, I'm bullish. The average volume is 8.6 million. The high volume is 23 million, putting this in the $65 area. This sold off with 53 million in volume when it hit the low 80 area. If this holds this area with the average volume, this can get back to the mid 80 area, maybe higher. If the volume declines, this could bounce back down at the $63 area. Charting of Roku Inc., ticker symbol ROKU. The tech space seems to be pulling back a bit, maybe due to people curbing their spending or shifting their money to other sectors. This might have a small bit of correcting left in it. This trades with the average volume of 3.8 million. The high volume of 36 million took this to the 90 area. This sold off with 40 million in volume around the $78 area. If the volume doesn't pick up, this could bounce in the $59.50 area. If buyers come in with increasing this volume over the average, this could get back up to the $80 area. Charting of SoFi Technologies Inc., ticker symbol SOFI. Another one in the consumer space, but SoFi not only has school loans, they have mortgage loans as well. This trades with the average volume of 91 million. The high volume of 286 million took this to $9.45. It sold off with the volume of 110 million, putting it in the mid 8 area. If the volume falls below the average, this could bounce in the mid 6 area. If the volume comes in above the average, this could get to the 10 area or better. In getting back to things, here's the conclusion. Economic indicators offer valuable insights into the overall conditions of the economy, which can significantly impact the stock market. By understanding how key indicators like GDP growth, employment, inflation, and interest rates work and interact with each other, investors can develop a better sense of where the market might be heading. However, it's important to remember that economic indicators provide signals, not guarantees. No single indicator tells the whole story. Therefore, it's crucial to consider a range of indicators within their context to get more of an accurate view of the economy and economic environment. Additionally, economic indicators can change quickly, highlighting the importance for investors to stay up to date and continuously monitoring relative indicators and market news. Give this video a like if you found value. Share this video with others that are looking to change their trading game. And consider subscribing to get alerts for more Market Edge videos. Thanks again for watching.